This is a Japanese government bond. It's a loan. You lend the government money and it pays you a little interest. For 30 years, that little was almost nothing. There are over 1,000 trillion yen of them, and the bonds are only part of it. Japan owes more than twice what the country makes in a year. No government on earth owes more. And Japan doesn't owe it to the world. It owes it to itself, mostly to its own central bank, which bought nearly half of it and never had to sell. It worked so well that in 2016 people paid Japan for the right to lend it money. On paper, the safest debt crisis that never happens. Except the central bank stopped buying. It now owns less than half FY. The first time in 3.5 years, and it's raising rates on the way out. So what happens to the world's biggest debt when the buyer who made it painless walks away? That's what this video answers. And to get there, we'll look at 3 things. Who Japan actually borrowed from, why that stopped working this year, and the one number in Japan's own budget that tells you how this ends. Tokyo, the 20th of January 2026. Japan's Prime Minister Sanai Takaichi calls a snap election and campaigns on suspending the 8% tax on food for 2 years. According to CNBC, that one promise would cost the government about 5 trillion yen a year in lost revenue. Less coming in means more borrowing, and the people who lend Japan money noticed. Now, Japan borrows for 40 years at a time. A 40-year loan to a government is about the dullest thing in finance. The rate on it almost never moves. That morning, according to CNBC and the Japan Times, the interest on them jumped past 4%, for the first time since Japan started selling them in 2007. A bond that had never seen 4% saw it in a morning. And that's strange, not because it happened, but because it took 30 years to happen. To understand why, you have to know who was buying. 2 dates explain almost all of it. In 1999, Japan cut interest rates to 0, and more or less left them there. In 2013, its central bank started buying up the government's own loans on a scale nobody had ever tried. It stopped being a referee in that market and became its biggest customer. Which raises a question people rarely ask. If Japan borrowed all that money at almost no interest, who paid for it? Somebody did. For 30 years, ordinary Japanese savers kept their money in banks that paid them essentially nothing, while the government those banks lent to borrowed at essentially nothing. That's not free money. That's a transfer, a quiet one, from savers to the state, running for a generation. The debt looked costless because the cost was charged somewhere no debt statistic ever looks. Today, the Bank of Japan holds 485 trillion yen of these loans. One institution holding nearly half of a market bigger than Japan's entire economy. The research firm Yardini put it this way: this mutually assured destruction dynamic dissuades most from selling debt. In plain terms, almost everyone who could dump these loans is someone the dumping would ruin. So nobody moves. And there's one more thing about a central bank that matters more than anything else in this story. Think of a house you bought at the very top of the market. If you never sell it and nobody ever asks what it's worth, have you lost money? Not really, not yet. The loss only becomes real the moment someone makes you put a price on it. A central bank is an owner who never has to. It can hold those loans to the end and never write down a single yen, which works beautifully, right up until it stops buying. In March 2026, that share crossed a line it hadn't crossed since 2022, 47.9%, under half and shrinking. And in June, it raised interest rates to 1%. the highest Japan has seen since September 1995. The buyer who always showed up is now selling. And here's the part that makes everything else make sense. When interest rates go up, loans made at the old low rates lose value. They have to. Imagine you lent someone money at 1%. Now new loans pay 3%. Nobody is going to take your 1% loan off your hands for what you paid. They'll only buy it at a discount. You didn't do anything wrong. Your loan is simply worth less than it was. Now, Japan's banks, insurers and pension funds are holding 30 years worth of loans made when rates were near zero. And unlike the central bank, they do have to put a price on them. Every quarter. In public. The house they can never quietly hold. They have to say what it's worth. 14 trillion yen. That's the loss sitting on the books of Japan's 4 biggest life insurers, up 60% in a single year. And Nippon Life, the largest of them, has now written part of that loss down for real. Not a number on paper anymore, a number they've admitted. Meanwhile, the yen keeps falling. 163 to the dollar in late July, its weakest since 1986. In April and May alone, according to Finance Ministry data, Japan spent 11.7 trillion yen trying to hold it up. A record. A weak yen makes everything Japan imports more expensive. That's inflation. Inflation forces more rate rises. And more rate rises push those loans down further in value. The trap closes from both sides, which sounds like the start of a crisis. The people closest to it don't think it is, and they have a real case. Japan borrows in a currency it prints itself. It can always produce the yen it owes. That's what separates this from the debt crises that actually destroy countries. Those happen when you owe money you can't print. Neil Shearing, chief economist at Capital Economics, sums it up in 4 words. Japan's economy is reflating. Rates aren't rising because lenders are losing faith. They're rising because the economy finally is. Those are very different things. And something interesting is happening. Reuters reports that Japan's 2 biggest banks both plan to buy more government loans, now that they finally pay something worth having. MUFG's Takayuki Hara. With long-term interest rates showing signs of peaking, I think we'll cautiously rebuild our JGB position. For 30 years, almost nobody bought these because they wanted them. Somebody does now. Higher rates eventually help insurers too. 14 trillion is the cost of the transition, not the verdict on it. So which is it? There's a number that settles it, and it's already written Japan's own budget. Japan's own budget already assumes 3%. A year ago it assumed 2%. And Japan's debt doesn't all get expensive at once. The old cheap loans come due a few at a time, and each one is replaced by a new, expensive one. It's not a cliff, it's a staircase, and Japan has only just started climbing. So the real question was never whether rates spike, it's whether the interest Japan actually pays climbs past the number its own budget has promised it won't. And that's the answer to what we started with. The 30-year experiment was never debt without consequences. It was risk nobody had to put a price on. The debt hasn't changed at all. What changed is who has to admit what it's worth. 30 years bought Japan something real. Time. Time to grow old slowly, to change gradually, to avoid the brutal adjustment other countries were forced through. But time is never free. It's only ever billed later, to whoever happens to be holding the asset when the price comes back. And this is why Japan is worth understanding, even if you'll never own a single yen of it. Every rich country is running a smaller version of the same experiment. Borrow cheaply, keep rates down, let the central bank absorb what's left, and the cost never shows up anywhere you have to look at it. Japan just went furthest and got there first, which makes it the one place you can already see what the bill looks like when it arrives. So here's what I keep turning over, and I'd like your answer. If the risk was there the whole time and all that changed was who had to admit it, was it ever really cheaper? And there's a sequel to this already running. Just days ago, a 30-year-old trade built on cheap Japanese money came apart. We took it to pieces in the last video. This is the machine. That was the wreckage. Watch it next. That's Japan's debt reckoning. In focus. I'll see you in the next one.